Well, good evening, everybody. Welcome to our exciting, I don't know if it's exciting is ever the word with accounting, but I think it's exciting anyway, I like it. Our exciting class. Um, really, today I don't have a lot of announcements, although I do have a little bit longer presentation because accrual accounting concepts are often confusing for people. And so I'll take a little extra time to go over a few samples or examples that I have. But hopefully there'll be plenty of time for your questions too. So why don't we start with a prayer? Hey, Dinah, are you able to offer a prayer for us?
Sure, I
Great.
can. Our dearest and most gracious Heavenly Father, we're so thankful for the opportunity that we have to meet here as a class and for Brother Fox to be able to instruct us, to be able to understand the things that we have not yet understood in our class. We ask the Father to please bless him, that he may have thy spirit to teach us in a way that we may be able to understand and make them meaningful to our personal lives. We ask the Father to bless each and every one of us that are participating in this Zoom, that we may be able to listen and to be able to understand these concepts better. And we ask the Father to forgive us for our shortcomings. And we humbly say these things in the name of Jesus Christ. Amen.
Amen. Thank you very much. Um, I think some of you saw my message. I've been up in the mountains, so I've been a little slow responding. So hopefully nobody got
You look
stuck.
sunburnt.
Yeah, exactly. You always forget so you go up to 7,000 or 8,000 feet and you think, oh, it's not hot out, but you're getting fried. So that happens whenever we go to the mountains. Anyway, so I
But you
apologize.
lived. That's the important part.
What's that?
You lived.
Yeah, and the important part is I got to see my granddaughters. I haven't seen them in a few weeks, so that's nice. Anyway, so hopefully it didn't cause too much of a. I was able to check at least once a day and respond usually. So the only kind of general announcement I have is regarding the papers. So everybody, almost everybody, has submitted a rough draft or a first draft of their paper, and really, generally the comment I'll put is like something like, "This is a pretty good start. If you just participate in the peer review process, you're going to get full credit on it." And like, if I put that on your paper, I mean that. Okay, so it doesn't mean you have to make big changes. Other things that some people often do is they want to include way too much, and so they'll have like 5 pages, and when it says 1 to 2 pages, it means it, and I mean it. I have 100 students, and I don't want to do 5 pages. No offense, but it's enough to read 1 to 2 pages times 100 students. But by and large, very good papers. It's not meant to be a super hard one. It's meant to be find something in a career you're interested in and read about it and tell why you read about it, right? In essence. Another issue is a lot of times people will get a lot of hits on the originality report. That doesn't necessarily mean you've done anything wrong. It just means that to double check it and make sure you've cited the source, because you've done nothing wrong if you and the system can't tell whether you've cited it properly or not. So if you use quotes and things from it, it's going to give you a higher rating or a higher non-originality rating. And so for people who had that, my response was double check, make sure you've cited it correctly, try to paraphrase rather than do direct quotes. If 30% of your paper is in the exact wording of another source, that's probably a problem. That means you're not internalizing and paraphrasing enough. So any questions about the paper, or any other general questions, I guess? All right. Oh, Cheryl, go ahead.
Well, I didn't have a question per se. Will there be more? Because I didn't even realize that this was not the final draft.
So there's going to be this next week. There's a peer review where you look at a couple of other people's papers and provide some comments and grade it according to a little rubric that's in there. And on those, what I would ask is that you be honest but kind. You know, you don't have to like blast somebody and tell them their writing is horrible. But also, I mean, you can be helping them out if you say, here's what I noticed. And then there'll be a final draft, which again, for most people, it'll just be one more read through, double check to make sure there's not any real glaring problems, and you're good. Unless for a few people, I gave some very specific, annotations or things that needed to change. But for most people, they were good. It's not an English class, so I'm not trying to, I'm not an English teacher either. So I'm, unless there's like, every once in a while you'll read a paper where the grammar is so rough that it makes it hard to read the paper, and then it's clear that person needs additional writing help, right? And so we try to get them to a writing lab where they can. But I didn't see any that were like that in this group. It's usually my Arizona State University students. Don't tell ASU because they're very proud, but I get, in my junior and senior classes, I always get 3 or 4 people that I just have to go, man, like, really have someone help you write your resume. This group, the papers look pretty good. I didn't see any that were glaringly bad. So any other questions about the paper or other general questions?
You have a good time?
I did have a good time. I mean, we took a camper, so I didn't have to sleep on the ground. So that helps.
Well, I pretend you don't have a house, honestly.
But
Camper's good.
I used to do tent camping, and then I hit a stage where I was just like, no, we're not doing that anymore. Unless we're going on a pioneer trek or something where it's part of the experience. I'll
And
sleep in
dang, they
bed.
canceled those this year.
Yeah. We our first year we were so excited to do it, and then the next they were tried to say they're only going to have people be ma's and pa's like once, maybe twice in a row if needed. And then so we went a second time and we really enjoyed it. And then the third time, they ran short of people. They know I'm off in the summers, and so we got to go a third time. And at that point, I was starting to feel old. So I was still grateful for it, and I love the bond you build with the kids. But at some point, you're like, look at all these young people in our ward. I'm sure they can. But I will go again if I get asked. I'll go again every time. So I just have to figure out ways to haul my CPAP machine and an inverter so that I can run it, because as you get older and a little heavier, the breathing, I don't know. All right, we're here to talk about accounting, right? Sorry. And so if there's no other general questions, I want to give a little bit of a hopefully brief discussion on accrual accounting, because I think it's a challenging concept for a lot of people. Cash accounting, where I just sort of record it when I get money and then record it when I pay money, that's super easy and it's great, but it doesn't always match things very well to the time period in which they're used. If I buy a building for my business, I'm getting use out of that building for 20 years. And so to just claim it all as an expense the day I buy it is really inaccurate. And so what I've got to do is instead, claim that asset and then each year show that a portion of its cost is an expense to me in an ongoing way. And so that's what accrual accounting is really all about. Is about matching the expense to the time period in which we're getting value from the asset, or matching the revenue to the time period when we actually earn the revenue. So I'm going to bring up a little presentation. Just these slideshows you can find. I'm not even making my own slides. I'm using the ones that Wiley provides that you can find in the Wiley material. So I'm going to share my screen with you. Let's see. Okay, that was weird. So, like I said, I usually just try to have 4 or 5 slides, but there's several on this one. So I apologize, but it's because it's a more confusing concept. I'm going to go ahead and minimize that. All right. So this is kind of what I just talked about. This is why we have to have adjusting entries. And it's really because we have to recognize expenses when we earn them. I'm sorry, expenses when we incur them, and revenues when we earn them. And so that's confusing when we get cash at times when we haven't earned it, or when we pay cash before we've incurred the expense, or when the opposite of that happens. So I'm going to walk you through some examples here in a minute. So these are the 4 types of adjusting entries, which I'm sure you've already read about since we're at Thursday this week already. But so there's deferrals and accruals. Those are the 2 categories. And the term defer means to put something off until some point in the future. So when we defer an expense, it means that we pay the expense now, but it's not actually going to, we're not actually going to incur the expense until some future point. And with a deferred revenue or an unearned revenue, it's when someone pays us cash now, but we're not going to earn the revenue until some future period. So when we talk about deferrals, it means the cash is moving now. Either we're paying it for an expense or receiving it for a revenue, but we're deferring or putting off the recording of that until some future period where we actually incur the expense or actually earn the revenue. So that's one type of adjusting entry. The second is what's called an accrual. So to accrue something means to add it up over time. So an accrued revenue occurs as we earn the revenue, but we have not yet received cash. So we're accruing the revenue, earning it now, and we're going to receive cash in the future. And an accrued expense is the same thing. We're incurring expenses now, and we're not going to pay the cash now, but we're going to pay it at some future time. So to me, breaking it down that way helps me better understand it. And so let's see. So the first group, like I said, are deferrals, and typically we talk about deferrals in terms of either prepaid expenses or unearned revenues. So a prepaid expense is an expense that's paid before we actually incur the expense. Okay, so just remember, for prepaid expense, it's cash before expense. So the most common types are things like insurance. We'll pay that for a whole year. Rent, people, right? We will pay 3 months worth of rent or 6 months worth of rent. Things like supplies, where we, and so when we do this, our initial transaction is always to create an asset called prepaid insurance or prepaid rent, or an asset called supplies or equipment. Prepaid advertising, those sorts of things. So the initial transaction on a prepaid expense is always to create an asset. So we debit an asset account and we credit a cash account. So that's always the same for all prepaid expenses. The initial transaction, not the adjusting entry, which we'll talk about in a minute, but the initial transaction is going to involve debiting an asset account and crediting our cash account. So we're paying the cash up front, cash before expense. So our adjusting entry then is going to be to credit our asset account, reduce the amount of asset, and debit the expense account. So as we use up that prepaid asset, we use up some of that prepaid insurance, we're going to debit the asset account and reduce it, and then we're going to claim the expense, which will be a debit to the expense account. So the adjusting entry for a prepaid expense is always a debit to an expense account and a credit to an asset account every time. So just so you know, I'm only working on one screen here, so I can't see any of you. So if you have a question, you're just going to have to say it. Just don't be afraid to interrupt me. Because I'd rather you ask the question as we're going than at the end. So here's an example, supplies. So the Sierra Corporation purchases supplies costing $25,000 on October 5th. They record this purchase by debiting the asset supplies, and they would credit the asset cash. So that would be the initial entry. So then to make the adjusting entry, what happens is most people don't just keep track of every little supply they use, you know, a little piece of paper and write down each sticky note or each pen they throw away. So what they do is at the end of the period, the end of the month, they'll count up the amount of supplies they have on hand. So it says here, an inventory count at the close of business on October 31st reveals $1,000 of supplies are still on hand. What that tells us is if they had 2,500 and now they have 1,000, they must have used up $1,500 worth of supplies during the period. So their adjusting entry is going to be a debit to supplies expense and a credit to supplies. So now the balance in the supplies account will be $1,000, and their supplies expense will show that $1,500 that they used during the month of October. Prepaid insurance. So here they pay $600 for a 1-year fire insurance policy. So we would recognize that if it was $600 for a year, we could divide 600 by 12 and say the cost of insurance is $50 per month. So on October 1st, Sierra recorded the payment so again, their initial entry then would be to debit the asset, prepaid insurance, and credit cash, because they paid $600 for a whole year's worth. And then at the end of the month, they're going to do the adjusting entry, which is going to be to debit insurance expense for $50, the cost of 1 month's worth of insurance, and credit the asset prepaid insurance. So at the end of that period, the month of October, prepaid insurance will have a balance of $550, and the insurance expense will be $50. So if they keep doing this each month, at the end of 12 months, prepaid insurance will have a balance of $0, and the insurance expense will have a balance of $600. So we'll say that they have expensed or used up all of that prepaid insurance asset. Depreciation is another form of prepaid assets. What we do is, again, people always think depreciation means that we are has something to do with the value of the asset, and it's not really. So you can't look at the book value of an asset, which is its cost minus its accumulated depreciation, and say that's what the asset's worth, because the asset is worth whatever the market's willing to pay for it. Instead, depreciation is a process by which we allocate the cost over the asset's useful life. That's what we're really doing, is we're saying, okay, if it costs this much, then, and its useful life is 5 years, then we're going to divide the cost by its useful life, and that's going to tell us how much to expense or claim as an expense each period. So here's an example. They don't even give us the total amount. It just tells us right here that they're going to do depreciation of $480 a year for their office equipment, or $40 per month. So our adjusting entry will be depreciation expense of $40 for the month, and the accumulated depreciation equipment account will be credited $40. Accumulated depreciation is a special type of account that is called a contra asset. Contra accounts are accounts that are always linked up with a regular account, and then we use them to those to track the depreciation of the account. Well, accumulated depreciation account to track the amount of depreciation that accumulates over time. So on our balance sheet, we'll always see it listed as the asset. In this case, it was office equipment. And then it will say less accumulated depreciation on the equipment, and it will give some sort of a balance. So here you'll see at the end of October, the balance of the equipment account remains $5,000. That always remains at the cost. And then the accumulated depreciation on the equipment will be $40, and our depreciation expense will be $40. Over the lifetime of the equipment, this will continue to add up, the accumulated depreciation account, until we've completely depreciated the asset. Our balance sheet.
The Fox?
Yes,
I'm sorry. Could I ask a question about that real quick? Because
absolutely.
I never caught that before. So the equipment will stay at the original price until what point?
Until we get rid of it. So until we sell it or throw it away, Or sometimes we can, later on, we'll learn about making fair value adjustments, like say the market just won't bear the cost of the equipment anymore, and then we might make an adjustment. But typically, the equipment will remain on our books at cost until we get rid of it. So if you see this page, it shows our balance sheet will look like this. It will say equipment, and that'll list our cost, less accumulated depreciation on the equipment, which at the end of October was just $40, will give us what's called a book value of that equipment of $4,960. So when we've fully depreciated this equipment, the book value, it'll say equipment 5,000 less accumulated depreciation 5,000, and the book value will be 0 at that point.
Okay, but on the income statement, it would remain the 5,000 as an asset, but still have a notation, so to speak, with the accumulated depreciation.
Yeah, yes, on the balance sheet. And the accumulated depreciation, it's a legitimate account. It's just these contra asset accounts always get linked with a specific asset. So the accumulated depreciation on equipment account is always linked to the asset equipment.
Okay. So essentially it is lowering the assets, just not on that particular item.
Yeah, so it's important for us to always know the cost of the asset, because when we go to sell it, we're going to need that information. So that's why they just use a contra account and this concept of a book value, which is the cost less the contra account, accumulated depreciation on equipment, to show us our book value. So again, this isn't decreasing the value of the asset. It's just showing us how much of the asset we have claimed as an expense up to this point.
Okay. It makes sense. I just never caught it. It didn't.
Well, it's a little weird until you work with it, and then you're like, oh. Like I have friends who are accountants who their whole business is just they deal with fixed assets and depreciation. They're kind of specialists in that field. You think of a business like mine, I own a storage business. It's a very asset intensive business. I mean, I make my living on building buildings for $30,000 and then renting them out for $800 a month. And so I've got to invest a lot of money up front, and it's going to take, several years to recoup that cost. And so tracking the expense of that building, if I spend $30,000 on it, but it lasts 30 years, then it's really only $1,000 of an expense per year. And we have to track that.
Now, can we use that depreciation for tax purposes to lower our tax liability, or
Yeah,
is not even the same thing?
Yeah, no. So that's a good question. So depreciation expense is an expense, and so it goes on our income statement as an expense, and it reduces the amount of net income we have. So a business like mine, one of the great things about a storage business, as an example, is I have so many buildings that if I run the business correctly, I can often make $7,000 or $8,000 a year in positive cash flow, but actually have a loss for tax purposes, because that money I spent on the building was spent a long time ago when I first bought the building, but I'm still getting to claim a portion of that cost as an expense each year. And so you have to be careful when you decide how many years of useful life are in an asset. That impacts how much of a depreciation expense you're taking each year. And the IRS could ask you to justify that number. If I say my building only has a useful life of 10 years, then I'm taking a much bigger depreciation expense per year over 10 years than if I say it has a life of 30 years. That was a really long answer, but yes, it does impact ultimately your net income, which impacts your income taxes. All right, so let's move on to unearned revenues. Again, like I said, I wanted this to be brief, but it's kind of a complicated concept, so it's worth taking a little time to explain. So an unearned revenue is when we receive cash before we earn the revenue. Remember, we record our revenues when we earn them. So this happens a lot in my business. So I own storage buildings, right? And people will often say, hey, what if I just pay you for the whole year? So instead of paying me $40 a month, they give me $480 a year. Actually, they give me $440 and I credit them 1 month. But if I were to record that all as revenue the day I receive it, it could be very misleading. It could look like I made $440 this month, when in fact I'm only going to be making $40 per month over the next 11 months, and then I'll credit them the 12th month. So what happens is when somebody pays me cash in advance, what I do is my initial entry is always to debit cash, increase the cash asset, and credit a liability account called unearned revenue. The reason it's a liability is because I owe them the service. In my case, I owe them the use of my rental units for the next 12 months. And if I'm not going to deliver on the use of the rental units, then I owe them their money back. So the initial entry on an unearned revenue is always an increase or a debit to cash, and a increase to a liability called unearned revenue, so a credit to unearned revenue. That's not the adjusting entry, that's the initial entry. And so then each month, I'm going to do an adjusting entry to recognize that I've now earned a portion of that revenue, and my liability, or the amount of money that I owe back to the customer, goes down. So I'm going to debit the liability account and credit the revenue account. That's going to be my adjusting entry for every unearned revenue entry. Okay, adjusting entry is debit to liability account, credit the revenue account. So here's an example. The Sierra Corporation receives $1,200 on October 2nd from R Knox for guide services for multi-day trips, expected to be completed by December 31st. Unearned service revenue shows a balance of $1,200 on October 31st, on the October 31st trial balance. So their initial entry, which they don't cover on this illustration, when they receive that money, is they would debit cash would go up by $1,200, and they would credit unearned revenue by $1,200. That's the initial entry. So their adjusting entry then, at the end of the month of October, they determine that they've earned $400 of that $1,200. So their adjusting entry will be to debit the unearned service revenue account, which is a decrease to the liability, and credit service revenue to show that they've now earned $400 of that money. So that's it for unearned revenues. Anyway. Okay, so let's look at the accruals now. So remember that when we accrue revenues, it's usually what happens is certain businesses, like attorneys or CPAs for that matter, they do work for their clients throughout the month, and then at the end of the month they bill them for the number of hours they've worked. So they don't usually record those revenues until the end of the month, when they add it all up and say, okay, we've done this much service. And so an accrued revenue is where we earn the revenue before we receive the cash. So revenue before cash. Let's see. So with an accrued revenue, this tells us that the adjusting entry has two purposes. One is to show that the receivable actually exists, because we won't know that until we actually bill the customer. And then two, to record the revenue for the service performed. So here's an example of what it might look like. Anyway, sorry, so I skipped ahead, sorry. So our adjusting entry is going to look like this. It's going to be a debit to the asset account and a credit to the revenue account. Okay, so the asset account that we're always using for this, or almost always, is accounts receivable. So I get to the end of the month and say I've earned $1,000. I debit my accounts receivable asset and credit revenue because I've earned that revenue. So here's our example. Sierra Corporation performed guide services for $200 that were not billed to clients before October 31st. So on October 31st, they do an adjusting entry to debit accounts receivable and credit service revenue. There's the balances on the account. So remember on the deferrals, we always had to do the cash entry. That was the initial entry. And then our adjusting entries were when we earned the revenue or incurred the expense. So these are opposite. So with accrued revenues, we go ahead and record the revenue because we've earned it. Then later on, when they pay us, we'll do another entry. So with an accrued revenue, we're doing the adjusting entry to show, okay, we've earned these revenues and we have the asset accounts receivable. Then when the customer pays us, the account receivable will go down and the cash account will go up. Accrued expenses, this is where the expense is incurred but not yet paid. So the expense is recorded and the cash payment will come later, or expense before cash. This happens a lot with utilities and salaries, things like that. If you think about it, every day our employees work, we're incurring a salary expense, but we don't typically pay them until payday. And so normally we would just record the expense on payday when we pay them. But if we get to the end of the month and we've got to do our financial statements for the month, we'll have to go ahead and do an adjusting entry to show the salaries expenses that have been incurred by employees working but have not yet been paid because it's not payday yet. So again, there's two purposes to an accrued expense. One is to record the obligation to show that we owe it, and secondly, to recognize the expense. It's always going to be a debit to an expense account and a credit to a liability to show that we owe it. So here's an example. Sierra Corporation signs a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So we'd say 5,000, the principal, times the rate, 12%, times the amount of time, in this case, 1/12 or 1 month out of that, tells us that the amount of interest they incur is 50% per month. So on October 31st, they will recognize an interest expense of $50 and interest payable of $50. So recognize that they've incurred the expense because they borrowed the money, but they won't pay it until the note comes due. So it just becomes another liability. Salaries, here's another example. They paid salaries on October 26th. The next payment of salaries will not occur until November 9th. Employees receive total salaries of $2,000 for a 5-day work week, or $400 per day. So at the end of the month, we have to account for the 29th, the 30th, and the 31st. Those are the amount of the work days that have not been paid for. $400 times 3 days is $1,200. So all we're doing is saying, hey, at the end of the month, how much do I actually owe in salaries? Because I'm not going to actually pay them till the next payday on the 9th. But on my income statement, I want to show that I have incurred all of this salary expense. I've already recorded all the salaries from the previous days when I did the paydays, but these 3 days won't be showing unless I do an adjusting entry. So I'll debit my salaries and wage expense, $1,200, and I'll credit salaries and wages payable for $1,200. All right, so that was a lot of stuff. Any questions other than the ones that were, well, any questions that came up while I was going through that?
Are you going to talk about the unearned revenue?
I did talk about unearned revenue.
Then I missed it. Sorry, I had a class before. I don't understand why it's a liability.
Okay, well, I'll explain it again because I think it is a confusing concept. So unearned revenue is when you receive money, but you haven't earned it yet. The example I use is with my business. I have a storage business. If somebody pays me for, say, a whole year's worth of storage, I got cash, but I haven't earned it yet. And so I either am going to owe them their money back, or I'm going to owe them the use of my storage building for the next year. And so because I owe them something, it's a liability. Then each period, as I earn some of that by allowing them the use of my building, I'm going to reduce the amount of liability, the amount I owe them, and record it as a revenue because I've now earned it. So it's a liability because it represents services owed to somebody because they've paid you already for them. Does that help or no?
Kind of. I just couldn't or in the homework, I just couldn't understand why it was putting it in the liability, because for me, it was not a liability. We had earned the money.
Okay, but you haven't earned the money. That's what makes it unearned revenue.
Okay.
So if somebody pays you cash, but you haven't done anything for it, then you haven't earned it yet. And so that's the distinction. Whereas if I provide services to you and you pay me, then I'm just going to record that directly as a revenue. It's only unearned revenue if you pay me money that I have not yet earned.
Okay. I just, for whatever reason, I thought all expenses are liabilities and all assets are, well, everything else an asset. And so I just can understand the liability part of it. But thank you so much and I was there when you talked about that, but I guess I didn't catch it. Thank you.
No problem. I think it's one of the more confusing concepts in the chapter, that unearned revenue concept. Again, just remember it becomes a liability because if somebody pays you in advance, then you owe them their money back, or you owe them the service you promised to provide. Kristen, yeah.
Yeah, so just really quick, just to make sure that I clarify, can I just ask you, so like just for example, I just have a sprinkler guy coming tomorrow and I've already paid him for some of the service. Is that similar?
Yeah, so on his books,
yeah,
he would show that as unearned revenue, whatever you've paid him. Okay, meaning he's received some money, his cash went up, but he hasn't earned any revenue yet.
Right.
So he would have to record that as unearned revenue. Then when he does the job, he's going to record it as revenue and decrease that unearned revenue liability because there's no more liability. He's now performed the services he promised and doesn't owe you anything more.
Okay, thank you.
Any other questions about that or about, say, problems in the homework?
Can I complain about Wiley's?
You may complain.
It is really hard when you keep having to scroll down your screen. I mean, scroll down, scroll up to get information. I can't tell you how many times I have inverse numbers. And I know I should copy paste every time, but I don't always think it. It would be nice if we could if they would allow us to open that workbook in another screen and, work from that data into the homework. But I tried that, but it would only allow one person to be, you can only sign once.
Yeah, there's a couple tricks you can use if you want to try. One is if you do it in a separate browser, then you can have Wiley Plus open, say like in Internet Explorer and in Chrome, and that will let you look at it twice. I will often open it up on my iPad and have my iPad open next. Other times I see students, I know it's silly that you should have to do this workaround, but some people will take a picture of the data above on their phone, just take a picture of it and then use that. So as annoying as it is, I will tell you that it's way less annoying than the way we used to have to do it, which was students doing it on paper, scanning that, submitting it, me taking a week to grade everybody's papers and try to give them feedback when we're already moving on to the new concept. And so I'm not saying it's not annoying. I agree with you that it is, but it is actually an improvement of what we used to do.
Can I just throw this in there? One of the things that I do, because I'm frankly really lazy, I will cut and paste from the Wiley page into a Word document. So that way I can have it next to what I'm working on and I can cut and paste it.
Right.
I pretty much do that too. I use the snippet tool.
Yeah, I do. I snip too, but I can cut and paste some Word.
And then put that on my other screen and then scroll my homework down.
Yeah.
That's what I ended up doing.
The snipping tool is a good tool because it lets you just, in essence, grab a picture or whatever you want to grab a picture of and throw it into a Word doc or whatever. So, yeah, again, they're all workarounds, unfortunately. Where I teach this at another college and we use the Pearson product called My Accounting Lab. And it has less of that scrolling. They've solved that problem by letting you kind of open up the data in another window that will float and you can move it around, but it has other problems. So it's like I try to go to their symposiums and symposia and say, if you would just get people like me who teach at 3 colleges and use 3 different products, maybe we could help you design one that incorporates all the best of all 3. But like anything else, there's limitations, I guess. So yes, Ingrid, I agree with you. It stinks. The scrolling is, it's, do you ever watch the Jetsons cartoon? That's probably dated, but Mrs. Jetson would be at home working on her computers and things all day, and her husband would come home and be like, "How was your day, honey?" And she'd be like, "Oh, I've been pushing buttons all day, and my fingers are so sore." And I think we've actually arrived at that point in history where, we have these frustrations of scrolling, which really do stink when you're the one doing it, but relative to, like, I don't know, pulling a handcart across the plains or something, they I'm sure they would look at us and our problems today and be like, "Are you kidding me?"
Are you saying we have first world problems?
We do, but they're legitimate when you're in the middle of them. I completely legitimate, so I get it. Anyway.
Well, the second homework was what? The last question that was, I don't know how many question long it was. That was a scrolling down that I was just, oh, you got to be kidding me.
Do you at least have a scrolling mouse so you can just roll down?
No, it's on my laptop. And I have one last question in this regard of the exam. Are the exam, will they get more difficult as the weeks go by, or the level of difficulty is about the same?
So the level of difficulty is about the same. I'll throw this out there without meaning to sound scary, okay? But exam 2 traditionally has some of the lowest scores of all the exams. I think it's because if people did well on the first exam, they're like, I don't even have to study, I got this. And so they tank a little bit. And then the people who struggled on the early exams, the exam style doesn't change. So if it was hard for you before, it's going to be hard still. Like there's some questions that are honestly like intended to be tricky, and I hate that. To me, it's like you should test whether or not someone can do the work. That being said, the nature of accounting is that it is about attention to detail. So I think that's why, and I will tell you that all products I've used, Pearson, McGraw-Hill, and Wiley, they all like to make careful reading of the question an important part of being successful on the exams. So the short answer to your question is they don't go up in difficulty level. But this test, the next test, exam 2, has a lot of material that is difficult for people, like all of these accrual concepts and things. And so I think that's why the scores are often a little bit lower on it than the first exam.
Okay, thank you.
Can you go over a little bit of the homework?
Sure.
Okay. I had trouble with problem 4.2a part B.
All right. So let's see if I can. So I'm pulling it up. That's why I'm taking a second here. So we're talking, it was part 1 or part 2? Sorry.
Well, I thought it was part B. I mean, I don't have it pulled up. I just wrote myself a note to ask this.
Let's see. I have 4.2a.
4-2A.
Got it. Okay. So let me share my screen.
Actually, I don't want to leave what I'm working on to go into it because I'll lose it. So, because of course we can't open that twice. I got the dates wrong for the trial balances. I tried like 0601 and I tried 0630. I guess I got to go out because I got to see what I did. And I felt like I tried it twice, 2 different ways. And I'm like, I don't.
So are you talking about on the adjusted trial balance, or? So it starts by.
I don't know if this is helpful, but this particular problem, I struggled with it too. And it has down at the bottom, it has a video you can click on that goes through the whole problem. The numbers of this are different.
I know it has that on every question. I love that. I
Not
actually
on
must have figured
every
this out because I have it, it's all green. So that must not have been when I must have wrote down the wrong thing.
So just as a point of order, I guess, adjusted trial balances will always have a date of the last day of the period that they cover, because they're a balance. That means they don't cover a period of time, that they're just sort of a snapshot of the balance of your accounts as of this day. And so it'll always be the last day of the month, because that's when we do our adjustments. So this one was June, so it would be June 30th, 2017.
Right.
But
Well, I think where I was getting, I'm not sure if it was that one, it was 630 versus 630 BAL.
right,
Like
okay.
final versus adjusted. So I think if it's an adjusting entry that day, you just put 630, but then your final, you better put 630 balance.
Right, so like cash, which I'm showing right now, there were no adjustments to cash. Adjusting entries never actually impact cash. That's the nature of an adjusting entry. So it's just going to be the balance as of 6/30.
Okay.
But then like accounts receivable, it has a 6/30 balance, then it has the adjusting entry on 6/30, and then a new 6/30 balance. So whenever we do adjusting entries, we always do them at the last day of the month. So in essence, they're going to have this unadjusted balance as of the last day of the month, then an adjustment which occurs on the last day of the month, and then an adjusted balance on the last day of the month.
Okay. Could it say like 630 balance, and then could it say, it wouldn't say like a date prior to that?
No, because
Okay.
this is the adjustment you're making, and those adjustments are always on the last day of the month.
Okay. All right. Thank you.
I joined late, so I don't know if this question's already been asked, but like when I was doing the study part of like what we're required to do, like I would get the answers right, like the numbers, but if I wasn't inputting it exactly with the wording, then I'd get it wrong. I know that, are there going to be questions like that on the test where I've got to word it, like I've got to type in, does that make sense? Like it would have a blank spot where you have to type in like whatever it is, like
Becky, I think I know what you're talking about. Like where you type in cash, if you type it in your own handwriting, it won't recognize it. But as you start to type it, it does predictive text, and then you select it. Even if I wrote the same word, it won't count it.
Well, usually it does do that. I mean, I had that, but this time when I was doing the study, whatever, I can't even recall, but it's the study thing where you go through all that.
Orion?
Yeah, I guess, I don't know. It's part of it's like what was due today. I don't know what it's called. I'm in my car because I left work late, so I'm watching this in my car. But anyways, so I don't have anything with me to show, but I just noticed that like I would have the numbers right, because it'll have like a problem for you to do as you're going through the whole, and like it wanted me to type in like whatever the blank part that's like, I'm so sorry that I'm not.
No, that's okay. No, so on the exams, there's almost always a drop-down menu, or at the very least a predictive text. So as you start to type the account name, it's there. Occasionally there's fill-in blanks. You probably saw that, but the fill-in-the-blank is like a number. Right in the earnings per share ratio, and then it will give you like ridiculous detail on how it wants you to do it, which is just as confusing as the question. You're like, wait, if it's 0.2, is that 20%? Anyway, but so the short answer is there's nothing where you have to like type in words and it's going to mark you wrong for the words. It's going to let you do a drop down typically, or a predictive text box.
Okay, because I was understanding what numbers it wanted in there, but I was like, I'm not wording this right, and I know it didn't necessarily count against me, but it was just frustrating. So I was like, oh, I hope this isn't the case moving forward, that we have to like know exactly how to word it.
No, and that I get why that's frustrating, because what's always frustrating, one of the downsides of these systems like Wiley Plus, besides the scrolling, another downside is sometimes you can miss something because you didn't put exactly what it wanted or in the order it wanted, and then you tell yourself, I must not understand the concept. when you did understand the concept and it was just some quirk of the system, and that's, you know, that's a negative outcome from a learning perspective, is when somebody, you know, because mostly what we're trying to say is, does somebody understand this, and can they do these, can they demonstrate that they understand it? And so we want to give feedback that says, no, you don't understand this yet, so you're gonna have to try it again. But when you did understand it, and it was just because the system's being, you know, too narrow, I guess, in what it accepts as a correct answer, that can be a downside that I'm constantly trying to work with these, with Wiley. We can send them suggestions to work those kinks out, because I know it's frustrating. But again,
Okay.
That's the trade-off of getting immediate feedback and another try. Anyway.
Okay, thanks.
Any other questions or thoughts, or before we finish up, whatever we do at the end of something?
Is there going to be another like exam review with TA again? Because that was really helpful for me for the last exam. I know she's not for your class, but
yeah, so honestly, that was something that had never happened before, and she just sent out an email to me saying, I'm doing this, will you pass it on to your students? So the short answer is, as of right this minute, I don't know. I can email her and ask her if she's planning to do that and get the info, and put it out there. So short answer is, I don't know, but I will check.
okay, awesome, thanks.
I always give a long answer and then the short answer. I should just give the short answer and be done with it, but. All right. Well, I think we're winding down. I guess that's a good thing. So, if there's no other questions or comments or deep thoughts, we can end our meeting. Last chance. Anybody else? It'll be after we end the meeting that you'll be like, dang it, I was going to ask this or whatever. But that's life, isn't it? All right. Well, then, if there's nothing else, I'll offer a closing prayer so that I don't have to say who will offer it and then have that like awkward pause. And then I think almost everybody here has had a chance to do it once, so maybe it's my turn anyway. All right. So I'll offer the prayer. Our dear Father in heaven, we love Thee, and we are grateful for BYU Idaho and the opportunity it provides for people all over the world to not only receive an education, but to be prepared as disciple leaders in Thy kingdom. We are grateful to know that there are living prophets on the earth today. We're grateful for the Book of Mormon and additional scripture. And we're grateful for the way that the gospel of Jesus Christ changes us and brings us closer to Thee. Father, we ask for Thy Spirit to be with us as we seek learning, that we would have divine help and guidance. We ask for Thy Spirit as we navigate the challenges of life. And we ask Thee to bless and strengthen all those who are suffering, and strengthen our leaders as we navigate how to reopen our chapels and our temples, and have the blessings of meeting together. We love Thee again, Father, and we thank Thee again for BYU Idaho and the blessings it provides. And we say this in the name of Jesus Christ. Amen.
Amen.
All right. Well, have a great night, everybody.
Thank you.
Thank you.
See you later.
Thank you.